We're going to stay on Chinese real estate. Jim Rickards is back with me now, hedge fund manager, author of The Death of Money. He's been doing business in China for decades, just came back. So, Jim, I was reading in the journal this morning that Hong Kong, some transactions for real estate in Hong Kong are at 2-year lows, and the Chinese government wants it that way. They want foreign buyers to be disincentivized, and they want to take speculation out of the market. Why?
Well, because these are bubbles, and bubbles are very dangerous. Now, this is an exercise in popping bubbles by the government, but the problem is be careful what you wish for. It's a little bit like bungee jumping. It sounds like fun until it comes time to jump off the bridge. And you also have unintended consequences. The shadow banking system in China is so big. There's so many intercompany loans. What you call the density function is so thick at this point. No one knows where
the translation to that, Jim, is that there's tons of money swirling around outside of the traditional banking system that, quite frankly, no one can account for.
Correct. Wealth management products there are over trillions of those, but now there's this new kind of similar to Zytec in Japan in the 80s, where corporations are lending to other corporations intermediated by banks, but the bank's not doing the credit work. So when those loans start to go bad, it'll affect good companies. Will find they've got bad debts. The wealth management products are beginning to default. I expect all this. I talked about this in my book, but this is actually happening faster than I would have thought. So this could very quickly spin out of control.
So what is the worst unintended consequence? That the credit is not good enough, and if I'm company A and you're company B and I'm loaning to you directly, that honestly you're just not good for it?
The thing is, this could be a cascade where, the wealth management products go down. People show up at the bank. They want their money back. The bank says that's not a bank deposit. It's a private product. But they blame the bank anyway. Then they take their deposits out. There's a run on the bank. The government has to come in and prop up the banks. The corporations can't get bank loans. They default to each other. And it just spirals out of control. It's exactly what happened in 2008. Now, the Chinese do have $4 trillion in reserves, so they can probably...
There's a little cushion.
There's a significant cushion, but in the short run, do Chinese banks sell good assets, U.S. assets, Treasuries, trying to raise cash to deal with the crisis while the leadership in Beijing are trying to figure out what to do? That's where what the IMF calls the spillover effects come in. Saw this in 07. The Japanese stock market was going down at the beginning of our housing crisis, and I was in Japan at the time, and everyone said, hey, we understand you Americans have a housing problem, but why are Japanese stocks going down? Because hedge fund managers were selling Japanese stocks to get cash to meet margin calls on the mortgages that they couldn't sell. So that's a very simple example.
Which is the idea of basically you sell what you can, not necessarily what you want to sell.
What you want, that's exactly right. And the Chinese banks may be in a similar situation where they've got a ton of bad assets, but they may start to sell good assets such as U.S. stocks and U.S. Treasury bonds to raise cash to meet some of the people who are banging on their door. This is already starting to happen. I mean, I've described this as a scenario, but it's beginning to play out.
All right, and I heard what you said faster than even you thought, which makes me pay attention. Jim Rickards, always good to see you. Thanks for coming in. Hedge fund manager and author Jim Rickards. So when